This is not a story about getting rich overnight. This isn't a fairy tale or some overhyped Wall Street dream. This is about discipline, strategy, and most importantly, the right mindset. If you're here, it's because you're ready to understand the real rules that make the difference between failure and success in the world of trade have one thing in common. They followed a set of rules. Some rules made them rich. Others led them to ruin. But what I'm about to share with you aren't the rules you'll find in any textbook. These are my rules, the rules I learned through trial, error, and most importantly, experience. When you enter the world of trading, one of the first things you need to accept is this: the market is never wrong. You are. The sooner you understand this, the sooner you'll stop trying to outsmart the very force that drives the financial world, the market itself. I know that sounds hard to digest, especially if you're someone who believes in intuition or is used to making decisions based on theories. We all want to think we're in control, that we can predict the market's next move based on our research, our gut feeling, or some kind of strategy we've developed. But let me tell you this, the market doesn't care about your theories. It doesn't care about your predictions. It doesn't care about your hunches. What matters is price action. What's happening now, not what you think might happen next. In my early years as a trader, I made one of the worst mistakes a trader can make. I tried to predict the market. Prediction in trading is a trap. Everyone wants to feel like they're ahead of the curve. You want to be the one who calls the top or the bottom before anyone else does. The idea of being a market oracle is seductive, and there's no shortage of people who will tell you they have the secret to predicting the next big move. But here's the thing, nobody knows for sure what the market will do next. Let's go back to my early days. I had theories, I had logic, and I had a little bit of confidence. The stock market was an enigma to me, and I thought I could crack it. I thought that if I could just read enough charts, follow enough patterns, and listen to enough market wisdom, I could predict the future. But as it turns out, I was wrong. There's a specific incident I'll never forget, a turning point in my career that changed everything. I was watching a stock that had been rising steadily for a while. The volume was increasing, momentum was strong, and everything pointed to the fact that this stock was on the rise. But I thought, this stock has gone too far. It can't go any higher. It's bound to drop soon. So I did what any trader who thought they could predict the market would do. I sold short. I bet against the trend. You can probably guess what happened. The stock didn't fall. In fact, it kept rising. I lost badly. The mistake I made wasn't about the stock or the analysis. It was my mindset. I thought I could predict what the market was going to do next, and I bet my capital on it. But the market doesn't care about your predictions. It does what it does, and your job is not to guess its moves, but to react to them. One of the hardest lessons to learn in trading is that the market moves for reasons beyond your understanding. Sure, you can analyze all the data you want, but there will always be factors at play that you can't predict or foresee. The market is driven by a multitude of forces: economic reports, company earnings, geopolitical events, and investor sentiment that create a constant flow of information. But here's the thing, the market is not random. It has patterns, cycles, and trends. If you've been watching the market long enough, you'll start to notice them. You'll begin to understand that the market isn't always logical, but it's predictable in its irrationality. It doesn't always make sense, but it will often repeat certain behaviors. The mistake many traders make, myself included in the past, is trying to impose logic on something that isn't bound by it. You can't predict a market reaction to an event you haven't seen yet. What you can do, however, is learn to recognize the signals the market gives you once that event unfolds. I learned to stop predicting and start reacting. When I stopped trying to figure out what the market should do and started paying attention to what it was actually doing, my trading success took a sharp turn upward.
The first rule I ever gave myself after that early loss was this: never try to outsmart the market. Just react to it. When I stopped trying to predict, I started focusing on understanding what the market was telling me. Price action, volume, Momentum, these are the things that matter. The market doesn't lie. It can be fickle, it can be frustrating, but it always tells the truth. The key is knowing how to listen to it. There's a saying that goes, "The trend is your friend." And it's true. The market has a natural flow. Sometimes it's going up, and sometimes it's going down. When the market is trending in one direction, your job is simple. Follow that trend. Don't fight it. Don't try to predict when it will end. Just go with it until it tells you otherwise. Let me break it down for you. If the market is going up, you buy. If the market is going down, you sell or stay out. If the market is moving sideways, don't force a move. Wait until you see a clear breakout. You don't need to guess when the market will reverse. The market will let you know when it's done. You just need to be patient enough to wait for that signal. One of the hardest parts of trading is accepting that sometimes the trend is going to be against you. It's tempting to believe that you can spot a turning point before anyone else does and get in right before the market reverses. But doing so will often lead you down the path of failure. The market can stay irrational longer than you can stay solvent, as the old saying goes. You cannot predict when a trend is going to change, and you certainly can't predict when a correction will come. The market doesn't care about your theories or your gut feelings. Let me tell you, it's a tough pill to swallow, but once you do, your trading will change for the better. You'll start cutting your losses quicker and letting your winners run longer. You'll stop obsessing over trying to be right and start focusing on staying alive and making money. Looking back, my biggest mistake was trying to predict the market instead of reacting to it. The sooner I realized this, the better my trading became. I stopped fighting the market, stopped trying to outsmart it, and started simply following it. The market will tell you where to go. You just have to be smart enough to listen. The market is never wrong. You are. This is not just a catchy phrase, it's a mindset. A mindset that will save you from making costly mistakes. The market is a complex beast, and it's impossible to predict every move it makes. But if you learn to respect it and react to its signals, you'll find yourself on the right side of most trades. In the end, it's about discipline. It's about accepting that you can't control the market. You can't predict it. You can only react to it. The sooner you internalize this, the better your chances of success in trading will be. So when you enter a trade, don't do it because you think you have some secret insight. Do it because the market is telling you it's time. If you do this, you'll find that your chances of success improve dramatically. The foundation of successful trading comes down to one simple idea. You must always be on the right side of the market. But what exactly does that mean? It means identifying the trend, understanding the forces at play, and positioning yourself in a way that supports the market's natural movement. There's a temptation in trading to feel like you can predict when a trend is going to reverse. Maybe you think a stock has gone up too much, or that the market is overdue for a correction. You start thinking that this is the moment when everything is going to fall apart. But the market doesn't operate based on your expectations. It doesn't care about your opinions or when you think it's time for a pullback. The market is always right. You are not. And if you insist on betting against the market, you'll lose. Let me say it again. Never try to fight the market. If the market is going up, you go with it. If it's going down, you follow that too. Let's dive into the core mistake I see so many traders make, especially those who are just starting. They fight the trend. This is where the most common and the most costly mistakes happen. I remember a time when I was fairly new to the game. I saw a stock rising with incredible momentum. Everything was in place. Strong volume, positive news, and a powerful uptrend. But I didn't trust the movement. I thought, this can't keep going up. It's bound to fall soon. It's overbought. So I sold short. You know what happened? The stock didn't fall. It went up even more. I lost big. It took me a long time to understand why. I had believed I was being smart by anticipating a correction. But what I was really doing was betting against the natural flow of the market. It was like swimming upstream instead of letting the current take me where it wanted. The market is not your friend when you fight against it. When you try to go against the trend, you're betting against the collective actions of thousands, if not millions, of participants in the market. The market doesn't care about your prediction. It doesn't stop moving because you think it's overbought or oversold. Trends don't die when you want them to. Trends die when the market says they're done. And when that happens, you'll see it. But trying to time that exact moment will only lead to frustration. This is why sticking with the trend is so important. The market doesn't wait for you to catch up. If you're fighting it, you'll miss out on all the profits that come from simply following along. To be on the right side of the market, you first need to understand how to spot the trend. This is more than just looking at a chart. It's about recognizing the patterns and the momentum. Once you learn how to identify the direction of the market, you'll see that the moves become clearer and the decisions become easier. There are two types of trends you need to recognize: uptrends and downtrends. Both can provide great opportunities if you align yourself with them. The market isn't trying to trick you. It's giving you signs all the time. Your job is to learn how to read them. Uptrend. If the market is going up, you need to be buying. It's that simple. But the key here is recognizing that an uptrend doesn't necessarily mean that every stock is going up at the same rate. Some stocks will soar, others will inch forward slowly, and some might even remain flat for a time. But as long as the general direction is up, you stay in the game. The signs of an uptrend are easy to spot: higher highs, higher lows, and consistent volume supporting the price increase. When you see this happening, don't overthink it. Just position yourself to go with the flow. Downtrend. Conversely, if the market is going down, don't try to pick a bottom. Too many traders lose money by guessing when a stock will stop falling. If the market is trending downward, stay out or consider short selling, but don't try to catch a falling knife. Look for lower highs and lower lows. Recognize the signals. When the market shows weakness, don't go against it. Let the market tell you when it's time to get out. One of the most crucial aspects of trading is riding the trend until it shows signs of changing. But here's the thing. It's not just about entering the trade. It's about staying in the trade. Too many traders exit too early. They see the stock rising, they make some money, and then they start getting nervous. They think, this can't keep going up, so they sell, often leaving profits on the table. I've made that mistake many times, and it cost me. You have to understand that the longer you stay with the trend, the more you maximize your returns. But it's not about being greedy. It's about having the discipline to ride the wave until you get the signal that it's over. It's important to recognize that trends don't last forever, but your job isn't to predict when a trend will end. Your job is to recognize when the trend is still strong and when it starts showing signs of slowing down. One of the best pieces of advice I can give is don't exit too early. Let the trend take you as far as it can go, and when it shows signs of reversing, then and only then you get out. Here's the hard truth about trading. You will lose sometimes. It's inevitable. There are no perfect strategies, and there is no way to win 100% of the time. But here's the kicker. As long as you stick with the trend, your losses can be smaller than your gains. When you fight the trend, you're compounding your losses. You're trying to swim against a current that's far too strong for you to overcome. The result is you're likely to get washed away. But when you follow the trend, you're simply taking advantage of the market's natural flow. You can take a smaller loss when things go wrong, and you can let your profits ride when the trend is with you. That's how you build long-term success. Not by trying to predict the market, but by riding the wave until it signals that it's time to get off. At the core of fighting the trend is psychology. As traders, we have a natural inclination to believe that we can outthink the market. We want to believe that we can be right. But trading isn't about being right. It's about being profitable. This desire to be right comes from ego. We don't like to lose. We want to think we're smarter than the market, and that's where traders get themselves into trouble. When you let your ego dictate your trades, you start making emotional decisions. And when you make emotional decisions, you stop following the market and start trying to fight it. This is why discipline and self-control are so important in trading. You need to understand that the market is bigger than your ego. It doesn't matter how much you think you know. The market doesn't care. It's going to do what it's going to do, and the best thing you can do is react accordingly.
To wrap up this chapter, let me leave you with a simple rule. Always stick to the right side of the market. The market will tell you which side is the right side. You don't need to guess. You don't need to predict. Just watch, listen, and react. If the market is moving up, buy. If it's moving down, sell or stay out. Don't fight it. Don't try to outsmart it. The market is always right. You are not. When you align yourself with the market, you'll find that the process becomes easier. The market will reward you for understanding its direction. But when you fight it, you'll find yourself losing more than you win. Momentum is one of the most important concepts in trading, yet it is also one of the most misunderstood. When most people think of the stock market, they think of prices rising and falling in random patterns, subject to the whims of the market. But in reality, the market moves in waves. Sometimes those waves are strong and consistent. Those are the trends you want to ride. The key to making big money in the market is not trying to predict where the market will go next. It's about understanding momentum, that invisible force that pushes prices in one direction for a period of time. And the best part? Momentum is not random. It's a signal that something is happening in the market, something that you can take advantage of if you know how to spot it. Momentum in a trading context refers to the speed and strength of a price move. When a stock is moving up rapidly with increasing volume, it has momentum. When it's falling sharply, the same principle applies in reverse. The key to recognizing momentum is that it doesn't happen in isolation. It comes with signs that tell you something bigger is at play. Momentum isn't about timing a trade perfectly or catching the market at its highest or lowest point. Momentum is about recognizing the power of a trend once it's already in motion. A trend that is driven by momentum has the power to continue moving in the same direction longer than most people think. One of the biggest mistakes traders make is trying to catch a bottom or top when they see momentum. They think they're being clever by anticipating when the market will reverse, but in reality, that's when you lose. I've seen it countless times. A stock is moving up fast, and traders are so focused on thinking that it's too high or that it's bound to pull back that they miss out on the profits. When you're fighting momentum, you're betting against the market, and as I've stressed before, that's a losing game. Instead of trying to catch a reversal, you should be capitalizing on the momentum while it's happening. Once a stock starts moving in one direction, your job is not to outthink it. Your job is to ride it. Let the momentum guide you, not your feelings or your predictions. So, how do you identify momentum when you see it? It's not as difficult as it sounds. Here's what you need to look for. Strong price movement. The first sign of momentum is a rapid price movement in one direction. If a stock has been moving up steadily for days, especially with higher than average volume, that's momentum in action. The same holds true for a stock that's falling rapidly. Be sure to watch both upward and downward momentum. Increased volume. Volume is the bloodline of momentum. If prices are rising but volume is low, then it's likely not a true momentum move. On the other hand, if the stock is rising and volume is increasing, it's a strong sign that there's real momentum behind that move. Strong trend confirmation. Momentum isn't about small, short-term price movements. It's about sustained trends. A strong uptrend with higher highs and lower lows is a sign of momentum. Similarly, a downtrend with lower highs and lower lows shows momentum in the opposite direction. Momentum will show itself in the price structure, and your job is to recognize it when it happens. Once you've identified momentum, the next step is getting in on the move. Timing is important, but patience is critical. Too many traders make the mistake of jumping in too early, trying to catch the first move in a trend. But that's a dangerous game, because the early stages of momentum can be unpredictable. Instead, wait for confirmation. Let the stock show that it's moving in your desired direction and has the strength to continue. The best time to enter a trade during a momentum move is when the stock is pulling back temporarily, a small retracement, and then resumes its upward or downward movement. This is often called a flag or pullback in technical analysis. Why is this the best time? Because you're not jumping into an uncertain move, you're entering after confirmation that the momentum is still intact. The market has already shown you that it has momentum. Now you're just positioning yourself to capture the next part of that move. As powerful as momentum can be, it can also be dangerous if you don't manage your risk. I can't emphasize this enough. Never go all in on momentum. Just because a stock is moving in your favor doesn't mean it will continue forever. You must always have a clear exit strategy and know when to cut your losses. The best traders are the ones who can ride the wave of momentum and know exactly when to get out. They don't get greedy, and they don't let emotions drive their decisions. If the momentum shifts, they get out. If the market shows signs that the trend is weakening, they cut their positions and protect their capital. A simple rule to follow: always set a stop loss. This is essential when trading with momentum. Even when you're riding a strong trend, the market can turn against you in an instant. Protect yourself by setting clear stop losses based on your risk tolerance and the volatility of the stock. Another misconception about momentum is that it only works for short-term trades. That's not true. Momentum can be applied to both short-term and long-term strategies. The key is to understand that momentum is a market force, not just a time frame. For short-term traders, momentum provides quick opportunities to enter and exit trades based on the current trend. But long-term investors can also benefit from momentum by spotting stocks that are showing consistent growth. They're not concerned with the daily fluctuations, but are focused on capturing the big trends over time. Momentum trading is about recognizing trends that are sustainable, not just fleeting. Momentum trading is also a psychological game. When you see a stock moving strongly in one direction, it can be difficult not to feel the pressure to act quickly. There's a rush of excitement as the market is moving in your favor, and it can be tempting to double down and increase your position. But here's the thing: don't let excitement cloud your judgment. Momentum moves are powerful, but they don't last forever. The key to momentum trading is discipline. You need to stay calm, stick to your plan, and execute based on the signals, not your emotions. When you're trading momentum, there will be periods of volatility. Prices won't always go up in a straight line, but it's important to remember that this is part of the process. Momentum traders understand this. They expect fluctuations and are prepared for them. The best way to handle volatility is to stay focused on the trend and not get distracted by every small dip or rise. In summary, momentum is one of the most powerful tools in a trader's arsenal. When you learn to identify momentum early, you can position yourself to ride those big moves, locking in profits as the trend moves in your favor. But don't make the mistake of fighting momentum. Don't try to predict when it will end. Instead, focus on riding the wave as long as it's moving in your favor. Let the market show you the way, and when it signals that the trend is over, exit with discipline.
Momentum is not just a short-time phenomenon. It's a force that drives the market and can be captured for both quick profits and long-term gains. By understanding how to recognize momentum and how to trade it, you'll put yourself on the right path to success. The key to successful trading isn't just about picking the right stock or the right trend. It's about knowing when to enter the market. This is one of the most difficult aspects of trading, and it's something that most beginners get wrong. They often jump in too early, too late, or at the wrong time altogether. It's easy to get excited when you see a stock moving in your favor. You may think, this stock is going to the moon. I need to get in now before it's too late. But here's the hard truth. Getting in too early can be just as damaging as getting in too late. Timing matters. You can't just jump into a trade because it looks good. You need to wait for the right moment to strike, when the trend is confirmed and the risk of a reversal is minimized. This is where riding the wave comes in. Riding the wave means identifying when a stock or market is showing strong momentum and then entering at the perfect moment to maximize your gains. The goal is not to chase the stock, but to position yourself strategically when the trend is already confirmed and the odds are in your favor. One of the biggest mistakes new traders make is jumping in too early. When you see a stock moving up quickly, your gut reaction may be to buy as soon as possible. The problem with this is that you're entering the trade without confirmation that the trend is strong enough to sustain itself. Let's say you spot a stock that is starting to rise after a period of consolidation. It looks like the trend is about to change, and the stock seems poised for a breakout. The temptation is to buy in early, before the stock really moves. But here's the issue. Early entries are risky. When you buy too early, the price could pull back before the trend takes off. You've exposed yourself to unnecessary risk because the stock hasn't proven itself yet. It's still in the early stages of moving. You don't want to chase the trade without confirmation that it will continue in your favor. You might be thinking, but what if I miss out? That's a natural fear, and it's one that many traders face. But let me tell you this, don't worry about missing out on the first few percentage points. The key to successful trading is staying disciplined and entering when you have a clear signal from the market, not when your emotions are telling you to rush. So, how do you know when it's the right time to enter a trade? The answer lies in confirmation. Let me explain what confirmation means in trading. Confirmation occurs when the market gives you clear, visible signs that the trend you're watching is real and that it has the potential to continue. It's like waiting for the green light before driving through an intersection. You don't want to go unless you're certain the path is clear. Breakouts and resistance levels. One of the best times to enter a trend is when a stock breaks through a significant resistance level. This means the stock has been held back by a price ceiling, resistance, for some time, but once it breaks above that point, it's a signal that the trend is likely to continue. The breakout tells you that there is real strength behind the move. You may see a stock consolidating within a specific range. As soon as it breaks above resistance with strong volume, that's your signal to get in. The key here is waiting for that confirmation that the price is willing to move higher. Pullbacks and retracements. Not every entry point is at the breakout. Sometimes, after a stock has moved up, it will pull back slightly, creating a small retracement. This can be an excellent opportunity to buy. Why? Because it offers you a chance to enter at a better price while still riding the momentum. The trick here is not to catch the first dip. Instead, you wait for the stock to stabilize, and then, when it resumes its upward movement, you buy. This is your confirmation that the trend is still strong. A pullback isn't a sign that the trend is over, it's just a brief pause in the action. Volume confirmation. One of the most critical aspects of confirming a trend is volume. Without volume, momentum can't sustain itself. If a stock is rising but the volume is low, then it's probably not a true momentum move. But when the stock is rising with strong volume, that's a clear indication that there's interest and strength behind the move. Pay close attention to volume spikes. When you see volume increase on an upward move, that's a confirmation that the market believes in the move. Similarly, if a stock is pulling back but the volume decreases, it's a sign that there isn't much conviction behind the pullback, and the trend could continue. Price action and market sentiment can also be a powerful confirmation tool. If the broader market is trending upwards and a particular stock shows strong upward price action, that stock is more likely to follow the trend. Conversely, if the broader market is weak, a stock moving upwards against the overall market sentiment could indicate a reversal is coming soon. You should always be aware of the market context in which you're trading. A stock that looks good on its own might not be as strong if the market is showing signs of weakness. Conversely, a stock moving up in a bullish market has a much better chance of maintaining its momentum. Timing your entry is not just about getting in, it's also about avoiding bad entries, like chasing the stock after it has already gone too far. One of the most common mistakes traders make is chasing stocks. This happens when a stock moves sharply in one direction, and you decide you need to get in before it runs even higher. The stock might have already gone up 10, 15 or more %, and you think, I can't miss this, I need to get in now. But here's the thing about chasing. You're buying at a price that is far away from the trend's origin. It's dangerous. A stock that has already moved significantly may be more prone to a reversal, and you're entering at a point of higher risk. If you enter a stock after it has already moved a significant amount, you're buying into the strength without waiting for confirmation. A pullback could happen right after you enter, and you could get trapped in a losing position. Chasing stocks is the quickest way to lose money. Instead of chasing, wait for confirmation that the trend is still strong and that it is safe to enter. This could be after a pullback, a consolidation phase, or a resistance breakout. While price action is a critical tool for confirming trends, technical indicators can help you solidify your decision-making process. Indicators like the Relative Strength Index, or RSI, or Moving Averages, or MA, can help you assess whether a stock is overbought or oversold and whether it's time to enter. RSI, Relative Strength Index. RSI measures the speed and change of price movements. A stock that's overbought with an RSI of 70 or above could signal that the price is due for a pullback. On the other hand, an oversold stock with an RSI below 30 could indicate that it's ready for a reversal and an opportunity to buy. Moving averages. Moving averages like the 50-day or 200-day MA can help you confirm whether a trend is likely to continue. If the stock price is above the moving average and it's moving upwards, it's a sign that the trend is strong and likely to continue. If the stock crosses below its moving average, it could signal a trend reversal. The key takeaway from this chapter is that the best time to enter the market is when you have clear confirmation of the trend. Whether it's through a breakout, a pullback, or increased volume, waiting for confirmation will give you a much higher chance of success than jumping in early or chasing a stock. Don't be afraid of missing out on the first few percentage points. Instead, focus on the long-term gains that come with riding a trend with strength and conviction. Enter the market when the signals align and when the trend is solid, and you'll find that your chances of success improve dramatically.
When people think of trading, they often think about the excitement of big wins, catching that perfect trade, watching the stock price rise, and raking in profits. But what most new traders don't realize is that it's not the big wins that determine your success in trading. It's your ability to manage risk and your position size. Position sizing is the foundation of a solid risk management strategy. Without it, you're essentially gambling. The amount of capital you risk on each trade determines how much you stand to lose if things don't go your way. This is why position sizing is one of the most important aspects of trading. It allows you to stay in the game over the long term, even when you face inevitable losses. In this chapter, I'm going to explain why position sizing is the key to your long-term survival in the market, how to calculate your position size, and why it's critical to protect your capital. The most common mistake traders make, especially beginners, is risking too much on any one trade. This could be because they're overconfident, chasing a hot stock, or simply don't understand how risky the market can be. Let me tell you, no matter how confident you are in a trade, the market can always surprise you. I've seen traders who were sure a stock was going to move in their favor, only to watch it fall apart and wipe out their entire position. This can happen in any market, at any time. That's why it's critical to limit how much you risk on each trade. Even if you think you found the perfect setup, you should never risk more than a small portion of your trading capital on any single trade. I've learned this the hard way, and it's one of the most important lessons I can pass on to you. The reason position sizing matters so much is that it helps protect your capital, the most important asset you have as a trader. Without capital, you can't trade. If you're risking too much on each trade, you're putting your entire account at risk, and you're one big loss away from wiping yourself out. Think about it this way. You may have a 50% chance of success on any given trade, but if you're risking 10% of your account on each trade, you're in big trouble. Even a series of small losses could destroy your account. But if you risk only 1 or 2% of your account on each trade, you can withstand multiple losses without putting your account in jeopardy. The goal isn't to make huge profits on every trade, it's to stay in the game. Consistency and survival are the keys to long-term success, not hitting home runs on every single trade. So how do you figure out how much to risk on each trade? It all comes down to your risk tolerance and the distance to your stop loss. Here's a simple formula to help you determine your position size. Determine the amount of risk per trade. Decide how much of your total account you're willing to risk on any single trade. A common rule of thumb is to risk no more than 1 to 2% of your total trading capital on each trade. Calculate the distance to your stop loss. A stop loss is a tool that automatically sells your position if the stock price moves against you by a certain amount. You need to set a stop loss to protect yourself from large losses. The distance between your entry price and your stop loss is how much you stand to lose if the trade goes against you. Let me be very clear, never go all in on a single trade, no matter how confident you are. Even the best traders in the world can't predict the market with certainty. If you risk your entire account on a single trade, you're gambling, not trading. I've seen traders blow up their accounts by taking on too much risk. They may have hit a few big wins early on, and that gave them the false sense of invincibility. But the market always humbles you, and it only takes 1 or 2 big losses to wipe out all of your gains. Instead, build your positions gradually. Start small, and if the trade goes in your favor, increase your position size. If it goes against you, cut your losses and reduce your exposure. While position sizing determines how much you risk on each trade, your risk-reward ratio determines how much you stand to gain in relation to your risk. The risk-reward ratio is simple to understand. It's the ratio of how much you stand to lose on a trade, your risk, compared to how much you stand to gain, your reward. For example, let's say you're risking $100 on a trade. Your stop loss is $100 away from your entry price, and your target profit is $300. Your take profit is $300 away. This gives you a 3-to-1 risk-reward ratio, meaning you're risking $1 to potentially make $3. A good rule of thumb is to look for trades with a minimum 2-to-1 risk-reward ratio. This means that for every dollar you risk, you should aim to make at least $2 in return. If your trades have a good risk-reward ratio, you can afford to be wrong more often and still make money over time. Here's the key: never risk more than you stand to gain. If you're risking $500 on a trade, but only hoping to make $200, that's a bad trade. A favorable risk-reward ratio allows you to be wrong more often and still make money in the long run. The goal is to win more than you lose, and with the right risk-reward ratio, even if you lose 50% of the time, you can still be profitable. One of the hardest aspects of position sizing is controlling your emotions. Greed and fear are powerful forces in trading, and they can cloud your judgment when it comes to determining the appropriate position size. Greed. When you're doing well and your trades are going in your favor, it's easy to get greedy and increase your position size. You think, I'm on a roll, I'll make more money if I risk more. But this is a dangerous mindset. Increasing your position size based on emotion can lead to overexposure and big losses if the market turns against you. Fear. On the flip side, fear can cause you to risk too little or avoid taking trades altogether. If you're afraid of losing, you might place tiny trades that don't generate enough profit to make a difference. You might even avoid good setups out of fear of losing money. The key to controlling both greed and fear is discipline. Stick to your position sizing rules no matter how tempting it is to risk more or less. Trust your system and stay consistent. Over time, the discipline of proper position sizing will help you stay in the game and grow your account steadily. The most successful traders are the ones who understand the importance of position sizing. It's not about how much you make on any single trade. It's about preserving your capital and making sure you can survive the inevitable losses that come with trading. By risking only a small portion of your account on each trade, you allow yourself the freedom to make mistakes, learn from them, and grow. Position sizing is the secret to long-term success in trading. With proper risk management, you can protect yourself from large losses and set yourself up for sustainable profitability. Remember, the market is a marathon, not a sprint. Position sizing is your strategy for long-term survival. Stick to it, and you'll find that your risk is minimized and your chances for success increase exponentially. You can have the best trading strategy in the world, the most sophisticated indicators, and a sharp understanding of market fundamentals, but if you don't have discipline, none of that matters. Discipline is the foundation upon which everything else is built. It's the ability to stick to your plan, to follow your rules, and to execute your trades without being influenced by your emotions. It's the discipline to cut your losses when they're small and to let your winners run. Discipline is the invisible force that allows traders to stay in the game over the long haul, even when faced with setbacks. In this chapter, I'm going to explain why discipline is the most important trait of a successful trader and how you can cultivate it to improve your trading performance.
One of the most common reasons traders fail is because they lack the discipline to stick to their plan. The market is full of temptations, false signals, unexpected moves, and emotional ups and downs that make it difficult to maintain focus. It's easy to get caught up in the excitement of a winning trade or the fear of losing one. And when that happens, traders often make impulsive decisions that undermine their strategy. Here's what happens. After a series of winning trades, traders start to get cocky. They think they have the market figured out, and they start breaking their own rules. They may start increasing position sizes beyond what's appropriate, or ignoring their stop-loss levels, thinking they can outsmart the market. But eventually, the market will remind them that it doesn't care about their ego, and they lose everything. On the other hand, after a series of losing trades, traders often succumb to fear. They panic, second-guess their strategy, and abandon their plan altogether. They become more conservative, risking smaller amounts and reducing their position sizes, often to the point where they miss good opportunities and never get back on track. Both of these scenarios are the result of a lack of discipline. Discipline is the ability to stick to your plan no matter what, whether you're on a winning streak or a losing streak. The key to surviving as a trader is consistency, and consistency comes from having the discipline to follow the rules. So, what does discipline look like in action? It's not just about having the right mindset. It's about following a set of structured, predetermined rules and sticking to them at all times. Let me walk you through some examples of how discipline plays out in real-world trading. Sticking to your stop losses. One of the hardest parts of trading is cutting losses when the market moves against you. Many traders feel emotionally attached to their positions and think, if I just wait a little longer, it'll come back. But this is a recipe for disaster. Discipline means accepting a small loss rather than hoping the market will reverse. You've set your stop loss for a reason. When it's hit, cut your losses and move on. Don't let emotions cloud your judgment. On the flip side, many traders sell too early when they're in profit because they're scared the market might turn. They lock in their gains quickly, but don't let their winners reach their full potential.
Discipline means sticking to your strategy and allowing your profitable trades to run until your target is hit or your exit signal triggers. Don't take profits too early just because you're anxious about the market's volatility. Avoiding overtrading. Discipline is also about knowing when not to trade. The market doesn't provide good setups all the time. Many traders make the mistake of trading too frequently, thinking that they have to be in the market all the time. They force trades when there's no real setup, just to feel active. Discipline means waiting for the right opportunities, those setups where the risk-reward ratio is favorable and the market conditions are in your favor. If there's no opportunity, don't trade. It's that simple. Keeping position size in check. Even if you have a good strategy, discipline means following your position sizing rules. Don't risk too much on any single trade, even if you feel the trade is perfect. Stick to your plan and manage your risk according to your predefined rules. Position sizing is part of your risk management, and discipline requires you to stick to it without exception. Trading is inherently an emotional activity. The swings between greed, fear, euphoria, and disappointment can be overwhelming, especially when you're faced with rapid market moves or sudden changes in direction. It's easy to let these emotions take over and make decisions based on how you feel rather than sticking to your plan. Let's break it down. Greed. After a series of wins, you might start to feel invincible. You think, I'm on a roll, I can increase my position size and make even more money. But this is where discipline comes in. Greed leads to riskier behavior, breaking your rules and overexposing yourself. This is one of the fastest ways to lose your profits and more. Discipline means resisting the urge to chase bigger wins and sticking to your trading plan. Fear. After a losing streak, fear can creep in. You might think, I can't afford another loss. I'll just take the small profits I've made and get out. Fear leads to overcautious trading or avoiding trades altogether, even when the setup is perfect. Discipline means trusting your strategy, even when you're facing losses. It's about understanding that losses are part of the game, and you need to stay consistent in your approach. Euphoria. After a big win, you might get excited and feel like you figured out the market. You feel confident and start making bigger trades, thinking that the market will always be in your favor. But euphoria can cloud your judgment. Discipline means staying grounded, even when things are going well. Don't let success go to your head. Keep following your plan, no matter what. Frustration. Sometimes, no matter how good your strategy is, you'll experience a losing streak. This can be incredibly frustrating and make you question your approach. But discipline means sticking to your plan and not letting frustration cause you to abandon your strategy. If you've done your research, if your system works over the long term, then keep executing it. Your discipline will get you through the tough times.
Building discipline in trading is not something that happens overnight. It takes time, patience, and a commitment to improving yourself as a trader. Here are some steps to help you build and maintain discipline. Create a trading plan. A solid trading plan is the foundation of discipline. Your trading plan should include your risk management strategy, position sizing rules, entry and exit strategies, and your psychological approach to handling losses and gains. A written plan removes emotions from the decision-making process and serves as a guideline to keep you on track. Set clear rules. Your trading plan should have clear rules, such as the maximum percentage of your capital to risk per trade and the conditions under which you'll enter and exit trades. The more specific your rules, the easier it will be to follow them in the heat of the moment. Practice patience. Discipline requires patience. You must learn to wait for the right setups, avoid impulsive decisions, and trust your system. It's about consistency. The market will provide opportunities, but your job is to wait for the right one. Keep a trading journal. Keeping a journal of your trades is a great way to stay disciplined.
You can track your wins, losses, and most importantly, your emotions during each trade. By reviewing your journal regularly, you'll learn where you need to improve and identify emotional patterns that may be negatively affecting your trades. Don't chase perfection. Trading is not about being perfect. You will have losing trades. Discipline means accepting losses and moving on, rather than letting them affect your confidence or trigger emotional responses. Every loss is a learning opportunity, and every win is a step closer to achieving your goals. The traders who succeed over the long term are those who master discipline. They don't chase the highs and lows of the market, and they don't get caught up in the emotional roller coaster. They stick to their rules and trust their system. Discipline leads to consistency, and consistency leads to long-term profitability. In the end, it's not about how many trades you make. It's about making good trades consistently. It's about executing your strategy day in and day out, regardless of whether the market is bullish or bearish, regardless of the emotions that come with each trade. By staying disciplined, you will give yourself the best chance of success even when the market is at its most unpredictable. You'll survive the ups and downs, and over time, you'll see the rewards of your consistency. In the end, discipline is the secret to surviving and thriving in trading. You can't control the market, but you can control how you react to it. By following your trading plan, sticking to your risk management rules, and avoiding emotional decisions, you will ensure that you're making the best possible moves regardless of market conditions. Discipline is the true differentiator between successful traders and those who fall by the wayside. It's the ability to trust your strategy even when things aren't going your way, and to keep executing the plan day after day. Remember, successful traders are not the ones who are always right. They're the ones who stay disciplined and follow the rules no matter what. Trading isn't just about entering at the right time. It's about knowing when to exit. This is where the most successful traders separate themselves from the amateurs. Too many traders focus solely on picking the right entry points and fail to give enough thought to when to close the trade. Knowing when to exit is as important, if not more important, than knowing when to enter. Here's the thing. You can be right on the entry, but if you don't know when to exit, you could still lose money. The market is volatile, and trends don't last forever. If you don't know when to take profits or cut losses, even the best trades can turn into disasters. In this chapter, I'm going to explain why your exits are just as crucial as your entries, how to develop a strategy for exiting trades, and how discipline plays a massive role in this crucial aspect of trading. It's easy to get caught up in the excitement of entering a trade. When you spot an opportunity, there's a rush of anticipation. The price is going in your favor, and it feels good to be right. But the real money is made in how you handle the exit. A trader can enter a trade perfectly, but if they don't know when to exit, they risk turning a profitable trade into a losing one. It's all about the timing of your exit, getting out at the right point, whether that's locking in profits or cutting losses. On the flip side, let's say you sell too early and lock in a small profit when the stock still has room to run. You might have won the trade, but you didn't take full advantage of the opportunity. Exiting too early can prevent you from reaping the maximum potential gains from a winning trade. Exiting correctly is all about optimizing your profits while protecting yourself from turning them into losses. In both cases, the key lies in knowing when to pull the trigger and when to let the market work for you.
The hardest part of trading isn't the entry, it's the emotional battle during the exit. This is where the true test of discipline comes into play. You'll feel fear, greed, euphoria, and regret when trading, especially when you're trying to decide whether to take profits or let a trade run. Greed. After a successful trade, it's tempting to think that the market will keep moving in your favor. Greed can cloud your judgment, leading you to hold on to a position longer than you should. Instead of locking in your gains, you think, what if it goes higher? I'll make even more money. But this is a dangerous trap. The market moves in cycles, and trends don't last forever. If you don't take profits at the right time, you might end up losing those gains and more. Fear. On the flip side, when the market moves against you, fear can set in. You might think, I'm going to lose it all. I need to sell before it gets worse. Fear causes many traders to sell prematurely, often cutting a winner too early or stopping out of a trade just before the market turns in their favor. When you let fear dictate your actions, you're trading emotionally, not logically. The key to overcoming fear is sticking to your exit strategy. Hope. Hope is another powerful emotion that can cloud judgment. You may hold on to a losing position, hoping the market will reverse and move back in your favor. Hope is not a strategy. It's important to recognize that if your trade has moved against you, it's often better to cut your losses quickly and move on, rather than hoping things will improve. This allows you to protect your capital and focus on the next opportunity. One of the most critical aspects of successful trading is having a clear exit strategy. An exit strategy is a predefined plan that outlines under what circumstances you will close your position. Without it, you're just guessing. There are two primary types of exit strategies you need to establish. Profit-taking strategy, target profit. This is where you set a predetermined price or percentage gain at which you'll exit the trade. You might set your target based on key technical levels, such as resistance levels or a favorable risk-reward ratio. For example, if you entered a trade at $100 and your target is a 20% return, your exit point would be $120. When the stock hits $120, you sell and lock in your profits. A good rule of thumb is to aim for a risk-reward ratio of at least 2 to 1, meaning for every dollar you risk, you should aim to make $2. By setting this target beforehand, you remove emotions from the equation and ensure you stick to your plan. Stop-loss strategy. This is just as important as your profit-taking strategy. A stop-loss is a predetermined price level at which you'll exit the trade if the market moves against you. It's essential to have a stop-loss to protect your capital and avoid catastrophic losses. For example, if you buy a stock at $100 and set a stop-loss at $90, you've limited your loss to $10 per share. If the stock price hits $90, you exit the position and take the loss without hesitation. The key is to set your stop-loss at a level based on logic, not emotion. It should be placed where the market will have to move significantly against you for the trade to be invalidated, but it should not be too tight where normal fluctuations would trigger the exit unnecessarily. You might have a target in mind, but how do you know when the market has changed and when it's time to exit a trade early to cut your losses? Here are a few signs that it's time to exit a trade before your target is hit or to cut your losses. Price action reversal. One of the most reliable ways to tell that the market has changed is when price action begins to reverse. This might be a sharp reversal after a strong rally, or the market fails to break through resistance levels after multiple attempts. If the price starts to show weakness, consider exiting before the situation worsens. Decreasing volume. Volume is a critical indicator of momentum. If the stock is rising, but volume starts to decrease significantly, it could be a sign that the trend is losing strength. Low volume on an uptrend signals a lack of conviction in the market, and it might be time to exit and lock in profits before the trend reverses. Divergence in indicators. If you're using technical indicators like the Relative Strength Index or moving averages, and these indicators show signs of overbought conditions or weakening momentum, it may be a signal to exit. For instance, if the price is making new highs, but the RSI is showing lower highs, it could indicate that the momentum is weakening. Market sentiment shifts. Sometimes broader market conditions or news events can affect your trade. If the overall market sentiment shifts from bullish to bearish, or if negative news breaks about the stock you're trading, you might need to exit earlier than planned.
Knowing when to exit is the secret sauce that separates successful traders from those who burn out. Exiting a trade correctly isn't just about locking in profits or cutting losses. It's about protecting your capital and staying consistent with your trading plan. Remember, the market will always have ups and downs. It's not about always being right, but about knowing when to take profits and when to cut losses. Your ability to exit a trade at the right moment is what will allow you to stay in the game long enough to see consistent profits and success in your trading career. If I could pass on just one piece of advice to any trader, it would be this: risk management is the key to long-term success. It's easy to get caught up in the excitement of big wins, chasing profits, or getting obsessed with your next trade. But without a solid risk management strategy, you're essentially gambling with your money rather than trading in a structured, methodical way. Many traders make the mistake of focusing too much on how to increase their profits and not enough on how to protect their capital. But the truth is, capital preservation is more important than profit generation. If you lose all of your capital, there's no chance to make more profits in the future. In this chapter, I'm going to show you why risk management is the foundation of successful trading, and how to implement a strategy that ensures you never risk more than you can afford to lose.
At the end of the day, risk management is what allows you to stay in the game long enough to succeed. You can't control the market, but you can control your exposure to risk. By implementing sound risk management techniques, such as setting stop losses, calculating position sizes, and managing portfolio risk, you ensure that no single trade will ruin your account. The most successful traders are those who protect their capital and manage risk effectively. If you risk too much on any single trade, you're gambling, not trading. But if you stick to your plan, manage risk carefully, and learn from your mistakes, you'll put yourself in a position to succeed in the long run. Introduction: the emotional challenge of trading. In many ways, trading is as much about psychology as it is about strategy. Your emotions can be your greatest asset or your greatest liability. Whether you're feeling the rush of adrenaline after a big win or the crushing despair of a loss, emotions can cloud your judgment and lead to poor decision-making. One of the most important lessons I've learned throughout my trading career is that emotions can be a trader's worst enemy. It's not the market that will destroy you, it's the way you respond to the market. Greed, fear, euphoria, and even frustration can push you to make irrational decisions that will cost you money. Successful traders understand this and develop the mental discipline needed to trade without letting their emotions take the wheel. In this chapter, I'm going to discuss the major emotional pitfalls that traders face, how these emotions affect trading decisions, and how you can learn to manage them for long-term success. Trading can feel like an emotional roller coaster. One minute you're on top of the world, watching your profits soar. The next minute you're staring at a loss, wondering what went wrong. If you're not careful, these extreme emotional highs and lows can influence your decisions and cloud your judgment. Let's break down the primary emotions that can impact your trading. Greed. Greed is a powerful emotion that can cause traders to take on more risk than they should. After a winning trade, you might feel invincible. You might think, if I made money once, I can do it again. So you increase your position size or hold on to a trade longer than you should, hoping to extract even more profit. The problem with greed is that it makes you lose sight of your risk management rules. Greed leads you to overexpose yourself, and when the market turns against you, the losses can be much bigger than they need to be. Fear. Fear is the opposite of greed, but it can be just as destructive. When you experience a loss, fear can cause you to second-guess your strategy or bail out too early from a trade. You might be afraid of losing more, so you cut a winner short or exit a position before the market has had a chance to run its course. Fear can also cause paralysis by analysis, the inability to make a decision due to uncertainty.
Fear of making the wrong move can prevent you from taking trades, or it can cause you to hesitate at the exact moment you should be acting. Euphoria. Euphoria is the feeling of extreme happiness that comes after a big win. When you've made money on a trade, you can start to feel like you've cracked the code, that you can do no wrong. This feeling of invincibility is dangerous. Euphoria often leads to overconfidence, where you start making bigger, riskier bets. You might abandon your trading plan, ignore your stop loss, or take unnecessary risks in hopes of repeating your previous success. But this is when the market can humble you. The next loss can be larger than you expect if you've let euphoria take control. Frustration. Trading is not always a smooth ride. There will be days when everything seems to go wrong. You miss opportunities, you make bad decisions, or you take unnecessary losses. Frustration can lead to impulsive actions, like entering trades too early, holding on to losing positions, or increasing your risk to make up for losses. The best traders know that frustration is part of the process. They don't let it influence their decisions. They have the mental discipline to step back, reassess, and stay calm even in the face of adversity.